Hey guys, today we'll talk about option plan. What do you mean by option and how can you can use option in the trading? In this chapter, we will see the detailed understanding of the option, so that option can have a better impact, and you can understand options in a better way. So today we'll get into this, and so starting with it, there's two type of option that we're getting into. First is call option, second is put option. Call option is nothing but I am taking a right to buy. Means if a particular share I take a call option, means I'm right to buy that share at the particular price. And there are put option. Put option means I got a right to sell the share at a particular price. In both the cases, if you take the option compared to the normal stock market option, we have to pay a certain premium amount. The option buyer option, we have to pay a non-refundable premium, certain premium, a small amount of money that we will pay, and this can we understand, this we will understand in the later part of the video. In the call option, we will compare our strike price and stock price. Is nothing like that. The strike price and there is a stock price. It means like what? X is the strike price. Strike price is the price that I am ready to pay, and stock is the actual stock price. That is, if strike price is less than X, then we will exercise. In this case, we have to make it possible. If my strike price is less than a stock price, we will exercise. For example, in case of Apple stock, if my strike price is 110 and my stock price is 90, then we won't exercise. We won't exercise me, because my stock is, I'm already getting a equity stock at 90. Why would I pay 110? Then we won't exercise. If the strike price is 110 and the stock price is 120, in this case we will exercise, because we are getting a stock at a much cheaper rate, at the rate of 110. That's the reason we will exercise. Our call option has a strike price is 110 and we are getting the stock at a much cheaper rate. That's the reason we'll exercise this stock at that rate. In case of a put option, we'll compare strike price with the stock price. It means that when put option is my right to sell, I will always sell my stock at a higher price. So in that case, if my strike price is more than my stock price, I will exercise this option. For example, we will take a same example that we take in call option. For example, in case of Apple, my strike price is 110 and my stock price is 90. In this case, my strike price is more than my stock price. We need to understand that when my strike price is more than my stock price, I will always exercise and I will sell my stock at this rate, so that I will sell my stock at 110 and I will earn a profit of 10 rupees per share. In the case of the put option, when the strike price is 110 and my stock price is 120, because I'm already selling the stock at 120, why will I sell my stock at 110? That's the reason I won't exercise this option. I won't exercise this kind of option. Hey guys, we already know there are two kind of option. There is American option and there is a European option. This kind of option we will get in each and every market. So the option can be done in two parts: American option and the European option. American option means anytime expiry. Anytime expiry is a basic funda, is like when I am taking a stock position for the 6 month. In this case, in the longevity of the 6 month, I can exercise my stock at any given point of time. For example, day 1, and there is day 1, and there is the day 2, and there is day 3. If I don't want to exercise my option at day 1, I can exercise the same at day 2. If I don't want to exercise at day 2, I can exercise the option at day 3. So I am feasible and I am more flexible in this scenario. In case of European option, I can exercise only at expiry. Expiry can be day 1, expiry can be day 3, expiry can be day 4. So I can exercise only at expiry. Expiry can be this or this. There is no flexibility and there is more rigidity. In case of profit, how to find out the profit in case of a call and okay, in case of option. In case of option, let me already understand. In case of call option, if we take Apple example, my strike price was around 1110, and my strike price is around 1110. Please ignore earlier my talk. My stock price is 90 and my strike price is 1110. I will always exercise my option and I will get my stock at the reasonable rate. So I will exercise this option and I can earn a profit of 10 if I premium paid. In the each and every option we need to pay an upfront premium. Premium can be a rupee amount, it can be 2 rupees amount, or can be 1 rupee amount. So in this example, we assume our premium will be 2 rupees. So we can make a net of 8 rupees in the entire profitability of the call and put option. So we will repeat it once again. There's two kind of bifurcation we can do. We can do an in the money option or we can out of the money option. In the case of in the money option means my stock price is greater than X price, then we will exercise my call option. In case of out of the money option, my stock price is less than my strike price, I won't exercise. In case of put option, when I'm having a right to sell, I will sell only when my strike price is higher and my stock price is lower. My strike price is higher and my stock price is lower. In case of out of the money option, my strike price is lower and my stock price is higher. In this case, I won't exercise my call option. I can exercise the call option at this level, I won't exercise at this level. There is a reason this is a basic summary of it.